What if the ratio, the spread difference between silver and gold, goes back to those old highs, 3%, 6%? Whoa, we're talking $300 to $500 silver, which is what we're targeting for silver, by the way. Silver is the one we're watching right now most, because silver is vastly underpriced to gold. It's vastly underpriced to every asset on the planet. In terms of history, you go back and measure where's the S&P and silver ratio, divide silver into the S&P, divide silver into gold, divide silver into whatever you want, especially back late last year when it was still in that 50-year range, $4 to 50, $4 to 50. Yeah, 50 years. No other commodity on the planet, no other base metal, for example, copper and lead, had blown out through a multi-decade similar range and done it back in 2005 for copper, 2007 for lead, quadrupled in price above that range high on their own, without a wave effect from other markets, and yet silver's confined for 50 years. What if silver catches up to gold? What if silver on a ratio basis, or not a ratio, but divide silver into gold? You go back to 1980 when silver was 50 at that peak, the bunker hunt peak. It was 6.5% the price of gold. Okay. Then in 2011, silver again went back to $50, again in that 50-year range, and it was 3.1% the price of gold. Divide silver into gold. Right now, it's 1.5 or 1.6%. What if the ratio, the spread difference between silver and gold, goes back to those old highs, 3%, 6%? Whoa, we're talking $300 to $500 silver, which is what we're targeting for silver, probably within the next handful of months. I think that's the place to be within monetary metals, because it is the one that has been restrained for so long, for whatever argument you want to use is why it was restrained. Williams, president of New York Fed, in November, had a press conference where he made a statement that the Fed is going to start, quote, buying bonds. The excuse he used was, just simply to provide liquidity to that market. Okay, go look where T-bond futures were back in November. Now, all they've done is slow the decline. T-bond futures were 117, 118, 30-year bond futures. Right now, they're trading 113 to 114 zone, okay? So they've continued down. Yields have continued to press up. They've not stopped that move. All they've done is maybe slow it a bit. But our technical assessment of T-bonds is that the sideways process we've seen in T-bonds in price and high in yields since the 2022 crash low in bonds. Late 2022, they crashed and price, yields went up. It's been sideways, trying to bottom, yields tried to top. They haven't been able to do it. We argue now that they're rolling over again, outside the control of the Fed. If that occurs, that's a whole new headline element of glacial proportions to the stock market. And the Fed does not control it, as evidenced by what they've done since November. Those are kind of issues that you need to be looking at. The Fed, Williams announced that last November they'd start buying bonds to provide liquidity. Well, that's a good excuse. But, if they've been buying bonds, the evidence they have, it hasn't done any good. And therefore, even Morgan Stanley's chief investment officer back 4 or 5 months ago said, hey, the 60-40 rule goes out the window. 60% stocks, 40% bonds. He didn't say it overtly like this, but, it was 20% bonds, 20% gold as well now, he said. But bonds aren't the alternative anymore. They don't help balance your portfolio. So, as the stock market recently had a sharp drop, the T-bonds didn't provide relief. And now the stock market's rebounded, but the bonds aren't rebounding. Yields are staying high, so they're not providing relief whatsoever. I'm talking government bond. That crisis can't get out of hand. That's bigger than any mortgage crisis we had. So 2007 and 9 is trivial compared to having what's going on in Japan happen to us, which is highly likely because our technical assessment says, okay, your holding pattern since 2022, October 2022, is over. You're now rolling over again to the downside. Here's the reality on gold. And this is not a target. This is simply a reality. If you go back to the 75 years, 50 years since it's been legal, got legalized, the gold was at the peak already in early 1975, January. It was $200. So you went into a bear market for the next year and a half down to 100. Start from that low in mid-76. Between then and 1980, you went up 8-fold. Take the bear low, multiply it times 8, went up 8-fold. Peaked in 2011, in 1980. Then you dropped, and in 2001 and 2, you had a low, quiet lows, in the $260 area, well above the $100 bear low that had occurred back in 1976. And you based, that was the low. You went up from that 260 level to what? 1920 over a 10-year span. Different time span, same dimension, 8-fold move, okay? Our bear low was 1,050 in December 2015. We're only traded in about 4-fold gain since then. We're half as much up in terms of price ratio move as we had in those 2 prior bull markets. Yet under conditions then were far less onerous and overwhelming as they are now. So we say, hey, if gold goes to 8,000 to 9,000, by the way, JP Morgan's come out with a report a few months ago suggesting over 9,000 as well. If that occurs, it's merely, oh, I did it again. Big deal. Okay. We got other factors that could take you a lot higher, but just 8,000 plus is merely, I did it again. Silver broke out back in November above a 10-year range of readings. So it said, hey, I'm out of this hole. I'm coming up. Okay. Where was silver then? $56, the November close. That was our last long-term buy signal for silver. That was it. No more. We're not going to offer any more major buy signals. If you're coming in now, you're late, but you're still going to make a lot of money. But $56, look what happened between that spread breakout in November, close in November, December and January, we're at 120 in 2 months. Yeah, you're back to 80 right now, but still you're 80 versus 56. Whoa, what gain that is. That's huge. And I think silver is highly likely to go to $300 to $500 in the next handful of months and do effectively what copper did in 2005 and 6, what lead did in 2007, and also change its relationship to gold to a more rational pricing. Those come and go, these sideline stories come and go, and they're all part of the ongoing wave that's underway. But remember, this wave has been underway for decades, silver and gold rising. Yes, it's been an arm wrestling rise where you say, well, was it rising? Sure it was. Yeah, look at it. Of course, silver was 10 years ago, 5 years ago, 1 year ago. It's been rising. Okay.
Before we wrap up, let's zoom out for a second, because what we're watching right now is bigger than one headline, one candle on the chart, or 1 day of price action. This is not just about silver going up 50 cents, or gold pulling back after a strong move. This is about something much larger happening in the global system. We are living through a period where trust is being tested everywhere. Trust in governments, trust in central banks, trust in currencies, trust in debt markets, trust in the headlines, and honestly, trust in the idea that the old financial system can keep running the same playbook forever without consequences. And that is exactly why gold and silver matter. A lot of people still look at precious metals and say, why would I care about silver? Why would I care about gold? They just sit there. They do nothing. They have no yield. That is the old argument. But the world we are moving into is not the same world that argument was built for. Because in a world of rising debt, geopolitical instability, currency debasement, weaponized trade routes, sanctions, proxy conflicts, fragile supply chains, and central banks trapped between inflation and recession, the thing that just sits there starts to look very powerful. Gold does not need permission. Silver does not need a bailout. Neither one needs a central banker to reassure you on television. And that is why every serious conversation about the future of money eventually comes back to hard assets. Now think about where we are today. Global tensions are not fading away. They are multiplying. The Middle East remains a pressure point. Europe is still dealing with long-term strategic instability. Asia is becoming more economically and militarily competitive. Energy corridors matter. Shipping lanes matter. Semiconductor supply chains matter. Food security matters. The dollar system matters. And every time one of these things gets shaken, markets start repricing risk. That repricing of risk is where gold usually gets the first spot. Gold is the monetary metal. Gold is the one central banks understand. Gold is the one they quietly respect, even when they publicly act like fiat is invincible. But silver is different. Silver is the metal that lives in two worlds at once. It is monetary, but it is also industrial. It is history and future at the same time. It is old money and modern technology in the same metal. That is what makes silver so interesting, and frankly, so explosive when momentum finally builds. Because silver is not just a shiny rock. It is used in electronics, solar infrastructure, industrial systems, advanced manufacturing, medical applications, and more. So when the world talks about green energy, electrification, reindustrialization, military tech, grid expansion, AI hardware, and supply chain security, silver is sitting right in the middle of all of it. That is why silver bulls never really go away. They may get mocked, they may get early timing wrong, they may have to sit through painful consolidation, but the core thesis keeps coming back because the metal keeps mattering. And let's be honest, silver has a personality that gold does not. Gold moves like a king. Silver moves like it just drank 3 espressos and saw a breaking news alert. Silver is calm until it isn't. That is why silver drives people crazy. It can look asleep for weeks, and then suddenly it moves like the market remembered all at once that above ground supplies are tight, demand is real, and the paper game only works until confidence starts slipping. That is the part many casual viewers miss. Most people only become interested in silver after it already made the move, after the breakout, after the headlines. after the FOMO starts, after the mainstream financial channels begin pretending they always understood the story. But real positioning usually happens when nobody is excited, when the comments are quiet, when the chart looks boring, when everyone is distracted by the next hot trade. That is how these markets work. And the geopolitical side only makes this more important. Every new conflict, every new sanction regime, every new currency settlement outside the dollar system, every new shipping disruption, every new defense escalation, every new energy shock adds stress to the financial architecture. Maybe not enough to break it in one day, but enough to weaken confidence over time. And markets run on confidence. That is the key point. The system does not need to collapse tomorrow for metals to matter. It only needs people to slowly realize that the system is not as stable, not as neutral, and not as durable as they were told. That is when gold becomes a signal. That is when silver becomes a story. And that is when retail investors, institutions, central banks, and everyday savers all start looking at the same assets from different angles. Some buy gold because they want security. Some buy silver because they want leverage to the same macro trend. Some buy both because they do not want all their faith sitting inside digits on a screen, backed by policy promises and political incentives. And can you really blame them? Look around. Governments keep spending, debt keeps rising, currencies keep getting diluted, wars keep threatening trade, politicians keep promising stability, and ordinary people keep noticing that their money buys less than it used to. That is not conspiracy. That is lived reality. This is why gold and silver are not just investments to many people. They are a response, a hedge, a form of skepticism, a statement that says, I do not fully trust the system, and I want something outside of it. Now, does that mean metals only go up? No. Does that mean silver cannot be volatile? Of course it can. Does that mean gold cannot correct? Absolutely not. But zoomed out, the bigger picture is what matters. Precious metals do not need perfect conditions. They need persistent stress, and the modern world is delivering plenty of that. That is why, on this channel, we do not just stare at price charts in isolation. We connect the dots, because silver is not trading in a vacuum. Gold is not moving in a vacuum. Markets are reacting to debt, diplomacy, war risk, central bank behavior, inflation expectations, real yields, industrial demand, and public psychology all at once. That is why one random headline can move these markets. That is why one central bank statement can change momentum. That is why one geopolitical flare-up can turn boring metals into the most interesting corner of the market overnight. And this is where the memes almost write themselves. One day the mainstream says, nobody needs gold anymore. Next week, central banks are stacking it. One day people laugh at silver holders. Next week, they are posting rocket emojis after a $2 move. One day, analysts say inflation is under control. Next week, your grocery bill files an official complaint. That is the clown world element of markets. You can almost picture the meme. Fiat currency after another trillion in debt spending. I'm tired, boss. Or this one. Silver investors after waiting for months and seeing a 4% move. Everybody stay calm. Everybody stay calm. Or the classic energy of the metals crowd. They called me crazy at 22 silver. They called me lucky at 32 silver. They called me again at 40 asking what to buy. That is the emotional cycle in a nutshell. And if you want a few tweet-style lines to flash on screen during this segment, here are some that fit perfectly. Gold is not chasing the news. It is pricing the loss of trust. Silver is what happens when monetary anxiety meets industrial reality. Every empire prints. Every market pretends. Gold remembers. Paper promises are infinite. Real metal is not. Geopolitics is bullish for uncertainty. Uncertainty is bullish for hard assets. Central banks buy gold while telling you everything is fine. That should tell you enough. Silver does not move when people are comfortable. It moves when comfort breaks.